All right, well, one of the big stories in the pre-market this morning has been weakness in technology stocks. In our newscast, we highlighted that Oracle shares are under pressure right now. Oracle, like a lot of big-name technology companies, has seen its stock rally big time this year, and part of that is tied to things like AI excitement. Now, in terms of the company's cloud sales, we saw Oracle ultimately fall short of lofty hopes. But when tech companies fall short, it does bring us back to worries about the overall economy, where the economy is going, consumer spending is going, as interest rates have been higher for obviously an extended period of time here, and you continue to get a narrative from central bankers about the possibility of those rates staying high, depending on where the inflation fight takes us. And of course, in the United States, we'll get another inflation read heading into tomorrow's trading session. Let's put it all in perspective. Michelle Schneider joining us. She's Chief Market Strategist at Market Gauge. Mish, nice to have you with us. Let's start with tech. As I mentioned, it's had a huge year, and Oracle this morning, an example of a company that fell short of some lofty expectations. Any takeaways from your perspective?
Well, it certainly was the greatest gainer even for us this year, was the whole NASDAQ growth space. But it's not surprising to see that the cycle starts to peak out at a certain point, particularly as pressure does come into the space with no fresh news per se. I mean, people are looking for Apple to really give a boost to the space today, but we'll see if that happens. It's been mostly a sell the news event with Apple when they come out with new products. So yeah, I think at this point, since so many areas of the market are on pause, given the fact that we have half the camp looking at recession and much lower prices and half the camp thinking soft landing, I would say that that NASDAQ and the growth stocks are telling you it's a good time to sort of just pause here and see what develops next.
What have you made of this general conversation about tech being at a new transition point? There's a popular view from some analysts, including at Wedbush Securities, that we are in a technology phase that perhaps we haven't seen since the early days of the internet. Even yesterday, for example, one of the big rallying stocks on Wall Street was Tesla, because a bullish analyst came out and said, well, Tesla's building a supercomputer that ultimately might unlock this new market where you can sell software and hardware associated with self-driving robo-taxis. Like, that's a different perspective than, is the economy going to fall into a recession for a quarter or two?
Well, there's a lot to that question. So let's start with Tesla. We know that Tesla is more than a car company. And so that analyst call obviously brought a lot of buying into what I'm reading today as one of the heaviest, shortest stocks out there, being Tesla. So, in terms of the whole technology space, there's what happens in terms of the fundamentals, and then there's what happens in the market. And we know that the market doesn't necessarily always reflect what's going on in the economy. And I think we can say the same thing here about tech, that it ran ahead of itself in many ways in anticipation of the tech advances. And we will continue to have major tech advances with AI as one, with metaverse as another. But at the same token, when things get too saturated, what happens is the market tells a different story. And that's what we're seeing here. One of the things that's happening, John, right now is that the huge wealth investors are buying bonds through the long bonds, and they're selling equities in anticipation that this whole thing can flip. So yeah, you want to keep your eye on that, but at this point now, it would not be a chase the growth stock type market, in my belief.
Okay, let's tie it all back to what central banks do. We mentioned we've got some inflation data to chew on as we roll through the week. We'll have a U.S. Federal Reserve decision on interest rates later this month. Looks like right now Wall Street does not anticipate any increase in rates at this meeting, although I guess the jury might still be out for the balance of the year. Of course, we just had a decision by the Bank of Canada where they decided to hold rates firm for now. They were in part indirectly citing the fact that you've seen some signs of excess demand waning. We saw contraction actually for Canada's economy in the second quarter. And then shortly after that Bank of Canada decision, you had a stronger than expected jobs report, which I think gets back to this tricky balance for central bankers right now.
Yes, and I say thanks Canada, because it was one of the reasons why the market has held up, in that it reflected the belief here that the Fed will do the same. Well, the numbers are going to be interesting because we've had this spectacular explosion in oil and energy prices. And now even natural gas, which is something I've been talking about, is starting to catch up a little teeny bit as China came in as a big buyer. So once you have that type of inflationary scenario, and then something you and I have talked about in the past, sugar futures, which are really high, partly because of exports being down, weather problems being a big factor there, Thailand, India. This is where it gets complicated. So the Fed's going to be looking at services. They're going to want to see a flat line or at least somewhat of a decline in the services area of the numbers coming out this week. Then I think if we see that, we may get the pause. But if that's escalated along with labor, as you mentioned, which is still strong, and on the heels of the numbers that could come out in the future based on what's happening here with certain commodities, the Fed could also surprise and be aggressive. It remains to be seen. But this, as you said, goes back to it's okay to be a little patient right here.
And at the end of the day, if you're trying to take the temperature of market mood as we head through the fall, we had a guest yesterday who was actually pretty positive on small cap stocks, which arguably that would be a vote of confidence for, let's say, the U.S. economy navigating through some of the hardship. But are there any particular charts worth watching or trends worth watching as we head through the fall?
Well, what has been outperforming actually have been the good old blue, right? The good old Dow industrial stocks have done very well, like IBM, for example. So we have our eyes there. But also, I'm looking at some of the medical pharmaceutical space. One stock that just is it's a cheaper stock, but comes up as an example is Teva Pharmaceuticals. We have a position in that. Otherwise, I'm still very focused on DBA, which is the agricultural commodity. We like Tesla. I mean, we'll see what happens there. And, there's still commodity-related stocks that are of interest that are energy-related, like tech, which is more coal, tech being TECK, not TECH. And there's a few others. We're watching the staples, but a lot of the areas that people anticipated would do well have done so well, they're rich. So we've rebalanced, we've taken profits, and like I said, we're doing somewhat of a patient wait and see before we start adding to the portfolio at this point. We had a good year, and we believe that it's smart to take profits here and have protective stops, but I'm not necessarily sure yet where we should pile in. Commodities would be my number one choice, but again, even that I would take a little bit easy right here as things are rich.
Okay.